because we sort of don't know, right? And like you say, all things being equal, maybe in your view, the stock market should be having a choppier time than it is. Are there things that are going to perform whether there's chop or not?
Yeah, I think those big names will continue to do well. One thing you have to pay attention to, I think the two most important charts I look at regularly are U.S. net wealth, and the Fed just updated that for Q3. U.S. net wealth, this is household wealth, is up to $160 trillion. It's up $55 trillion since COVID. So U.S. net wealth has grown about 50%. And then I also look at corporate balance sheets. Corporate debt as a percentage of equity, i.e. corporate leverage, is lower than it's ever been in recorded history. So households and corporations are sitting in an excellent spot. They have a ton of cash, ton of built up home equity as well as equity values. So you have to stay invested, but maybe you pull back. What hedge do you put on? You probably sit more in cash. You're getting paid 4.5% to 5% right now on the front end of the yield curve. You can go and find investments out there at 6 to 7 that are extremely safe. So build up your cash position and build up those really high yielding, low risk instruments on the bond side.
Scott, just to go back to the Mag 7 for a minute. I was talking with Julie at the top of the show, and clearly investors have moved in there. They've continued to work. I'm just wondering, Scott, do you see that as a point of possible concern that it's the Mag 7 again? I mean, don't we want as investors to see more of a broadening out?
I think it's definitely frustrating for stock pickers because you look at the Mag 7 and they're very expensive to traditional metrics, but they're also the companies that are spending a tremendous amount of money on R&D, and they have tremendous balance sheets. So they're kind of like the Nifty 50 of the 70s, but we're factoring in here R&D and growth as well. So when you factor all that in, yeah, can they continue to plod along and produce, double-digit type of returns and lead the market? For sure. And yeah, that equal weighted S&P is only up 16 to 17 this year. So it's doing okay, it's catching up, but it's definitely frustrating stock pickers.
And so what criteria, I guess, are you using here, Skylar, as you go into 2025?
With where bonds have gone, first of all, the risk-free rates, the Fed's set to lower rates a quarter next week. Maybe they only lower one time in the next year. Maybe we only get to 4.25, and maybe the back end of the curve goes up in value. And what's hard to really put a finger on is how weak the rest of the world is relative to the United States, and how much demand is coming into the U.S. stock market relative to Asia and Europe. So what is that? A third, a quarter of the uptick in PE this year? Nobody knows. But I think the U.S. is going to be the shining light for the foreseeable future. And that's going to bolster stocks, not only to where expected growth is and expected earnings are for next year, but also I think the PE ratio is going to continue to potentially grow, if not stay where it's at.
And Skylar, you mentioned that Fed meeting next week. I'm just curious, why cut it all here, Skylar? We got those inflation readings this week, which seem to suggest maybe we're kind of stalling out here on our progress back to Jay Powell's 2% target. The economy's growing, the stock market's working. Why cut?
Who knows? It makes no sense, honestly, other than that they've stated that they want to get back to a 4, and they're at 450. So, okay, and they'll use the language that there are lagged effects. So they'll use that language that the market hasn't even absorbed yet that September 50 basis point cut. So they'll use that language and they'll say, hey, look, if we get to 4, we're still going to have a ton of wiggle room if there's a calamity and we need to drastically lower rates. But we feel more comfortable that inflation is on its way back to 2, which puts R squared, the neutral rate, at roughly 2, right? So 2 plus 2 is 4. That's where they want to get.
We'll see if they get there. Skylar, thanks a lot. Appreciate it.
Take care.
We're just getting started here on Market Domination. Coming up as the AI race rolls into the new year, is Amazon emerging as the new front runner? We'll speak to an analyst on the other side about expectations for big tech in 2025. Plus, is a stock split imminent for one of the giants in the streaming industry? We'll discuss later in the hour. Stick around, much more Market Domination still to come.
Yahoo Finance has been releasing its coveted annual Company of the Year award since 2014. We'll reveal a winner in the following categories: Company of the Year, Surprise of the Year, Product of the Year, and Comeback of the Year. Be sure to tune into Yahoo Finance starting December 16th for the big reveal. Trust me, you won't want to miss this stuff.
As the AI race rolls into the new year, Amazon is emerging as another front runner, but a new regulatory environment looms in 2025, threatening antitrust headwinds for big tech. For more on all of this, we're bringing in Scott Devitt, Managing Director of Equity Research at Wedbush Securities. I guess Amazon might be one of the few companies where there hasn't been lately any kind of antitrust investigation, Scott. But it has been one that we've increasingly been hearing about as a top pick for folks going into next year. I know that's true of you guys as well. What do you think we're going to see from Amazon in the new year?
I think you're going to see all three businesses firing on all cylinders in 2025, and really for the first time since the pandemic. The retail business is back. All the excess capacity that was built for the pandemic is now being utilized. Margins are rising. Companies gaining share in retail. The advertising business is crossing over $60 billion of very high margin revenue. And AWS has crossed over $100 billion run rate of revenue and is now growing back at 20% again. So, the stock's actually done quite well this year, but we expect it to continue into 2025 as the company builds on this momentum.
Scott, I recently spoke to AWS CEO Matt Garman on the show, and I asked Matt, Scott, about this perception that's out there that when it comes to AI, AWS is kind of late to the party, that Microsoft and Google had kind of moved into pole position. And as you can imagine, Matt kind of pushed back on that, said that's just a perception, emphasized there are important differences in strategy between these three. But I'm just curious what you make of that. I mean, that perception that's out there, do you think there's any validity to that, Scott, or no, that is really just a perception?
Well, I think that Amazon and AWS sat in an enviable pole position, at the beginning of this kind of AI revolution, and the emergence of generative AI infusion into data centers. And now, you have strengthened competitors, most notably Azure, that is incrementally more competitive. But Amazon's still growing, and I think, and not only growing, but the growth is accelerating again, because what was actually negatively impacting the business that kind of led and fed to this narrative that it was losing relevance is just because their customers were cutting back consumption because the economy was weak. So now that that's recovering, all of a sudden the narrative is corrected again. And the reality is they're doing just fine. They're in a very strong position, as I'm sure you saw at Amazon reInvent, a lot of the product innovations that the company's putting out there. They sit in a very strong position, but doesn't mean that Microsoft doesn't as well, and that Alphabet's GCP product platform isn't in a good position as well. I think they're all net winners as these data centers get transformed from kind of legacy service to these AI-infused services that their customers can use over the next 10 to 20 years.
One other question, Scott, on AWS. I've spoken to some other tech analysts, smart guys, and they argued to me that, in their opinion, AWS has the broadest, deepest homegrown chips out there, full stop. And I'm curious whether if that's your take.
Certainly. I mean, they've done a great job with their Graviton chip, which is the legacy chip that's utilized in AWS data centers, and that accounts for over 50% of the incremental chip usage in their data centers in the past 2 years. And they have two new chips, one for training, one for inference, that they anticipate will do the same for their Gen AI needs as well. That does not mean that NVIDIA is not in a strong position. NVIDIA has done well, even as Graviton has been a key ingredient to AWS's success. But Amazon is probably best positioned to provide an alternative chip to NVIDIA, to its partners. And I would throw NVIDIA into that mix as well. They'll do quite well. I mean, this cycle, like all cycles, will at some point peak and normalize, but we're probably still a good 1 to 2 years from that.
Well, that's what I wanted to ask you about, Scott. When it comes to that transition, I mean, at what point will Amazon's chip be a viable competitor to what NVIDIA is putting out there in terms of specifically, sort of large language models? And if there is that transition, obviously, Amazon could sell it to others, but I also wonder on its own end what kind of cost savings that could eventually provide.
Well, in using its own chips, historically, it's what gave AWS a cost advantage versus peers, because they could, for a portion of their needs, produce their own chips that lowered their cost structure, allowed them to offer better and lower cost services to the customers. I think of it more as a supplement to NVIDIA than a replacement. And so there'll still be a need for NVIDIA chips on the margin, a little less so as time goes on. But I don't really think that the possibility that AWS chips are threatening to NVIDIA's dominance is really what's happening. And that's not a negative for AWS. Actually, they sit in a very strong position because they're going to be able to build some portion of their own chips in a way that their peers can't.
Scott, so you like Amazon. I know that you like Alphabet as well. I wanted to get your take on this news Scott, Google certainly made some headlines this week, debuted a new version of its flagship AI model. I'm just curious, Scott, as a financial analyst, what did you make of that? What does it mean for investors who are listening right now?
So I think that whereas AWS was a AI loser according to investors for a period of time, and now they're magically a winner again, I think Alphabet is back and forth in the eyes of investors in terms of whether AI is a threat or an opportunity for the company. And I'll tell you the way that we think of it. We think it's an opportunity. What's happening is the denominator is growing. And so when Amazon launched Prime, there was a perception that would take search share away from Alphabet. Amazon did extremely well on the back of Prime over the past 18 years, and yet Alphabet stock and the business itself has done quite well. Facebook came out of nowhere and has grown a $250 billion advertising business, and Alphabet still continued to grow. And it's because the use cases and the utility of the services is growing and the denominator is growing. So ChatGPT will be successful, as will other new innovative companies, but Alphabet will survive, just the same in this cycle as well. Now, it won't be the highest returning stock, but it's also a very easy stock to own. It trades at a sub S&P 500 multiple, generates significant cash flow, and is dominant in all of its businesses, and ultimately itself will be benefited by AI over coming years. And you've seen the stock come back to life here in recent weeks, and we think that's more indicative of what's actually happening in the business.
Scott, great to talk to you as always. Have a good weekend and happy holidays.
Thanks so much. You too. Bye-bye.
Now time for some of today's top trending tickers, sponsored by Tasty Trade. You can scan the QR code below to check out the best, worst, most trafficked stocks of the session on Yahoo Finance's trending tickers page. First up, a look at shares of Tesla, the stock at a new record. Remember, it's been hitting that record again this week for the first time in a long time. The gains coming most recently as the Trump transition team reportedly is considering scrapping the requirement for companies to report automated vehicle crash data. That is according to Reuters. So basically, the deal is this. Right now, anyone with an AV business, an autonomous vehicle business, has to report the crash data to NHTSA and the National Highway Traffic Safety Administration. That organization has been very closely zeroed in on Tesla and its full self-driving.
Yeah, I mean, what's interesting, Reuters saying, who had this story, saying they could not determine what role, if any, Musk might have played in crafting these recommendations, or they say they can't determine the likelihood that the administration would actually enact them.
Right.
But the stock move, I mean, so we're up to date. We're up about roughly 70% now since the election. It is a remarkable move, in part, of course, as we've talked about. I mean, this idea that investors are betting Musk obviously tight with our president-elect, and that perhaps means good things for his business, his self-driving ambitions in particular. We shall see.
A return on his $250 million investment.
Made a bet, and it was the right one.
Yeah, well, TBD. TBD.
Now, taking a look now at shares of Novo Nordisk, as a study shows the company's Ozempic shot is linked to a rare vision loss risk. So this one, we're talking Ozempic, linked to an increased risk of a rare form of vision loss in this study. And it looks like, Julie, diabetes patients who use Ozempic more than twice as likely to be diagnosed with this rare condition than those who took another type of diabetes drug. It does sound like the overall rate of the condition was very low in the study, but obviously it got attention, and obviously something folks should be aware of.
I have to say I was surprised. I looked at the year-to-date for Novo Nordisk, and the stock is only up about 2% or so.
Yep.
It had a big year last year, of course, on the introduction of Ozempic, but there's been this sort of steady chipping away after the enthusiasm that we saw last year, right? Part of it has to do with some of the maybe health risks. Part of it, of course, has to do with competition. Part of it has to do with supply shortages. But it's been interesting to see that sort of turn lower off the highs.
Yeah, and then of course you think about this other wrinkle too, whether RFK Jr. really does take the helm of HHS.
Right.
Not a fan of these drugs, as we well know.
We shall see. And turning now to a story just coming out in the past hour or so, Post Holdings reportedly working with investment bankers to explore a possible transaction with Lamb Weston. This according to Reuters, the two food companies, Lamb Weston, of course, the frozen French fry company. Those shares up some 6% on this report from Reuters. The two have or I should say, Post has had its eye on Lamb Weston before, but they haven't been able to get the deal done. So we'll see if that does happen this time around.
Yeah, it has not been an easy year for Lamb. The stock is down nearly 30% as we wrap out 2024. Remember in October, we talked about this. We heard activist investor Jana Partners had built a stake in the company, and the point there obviously is every activist wants. What do they want? They wanted them to explore strategic alternatives. So we'll see where this one winds up.
We will, but the stocks are moving in the meantime.
Coming up, there is a new member of the $1 trillion market club, but is the growth sustainable? We're going to be joined by an expert on the other side to break down the chip industry. Stick around. Much more market domination still to come.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Broadcom shares are surging as the chipmaker touts its massive opportunity over the next 3 years in AI. Broadcom's gains pushing its share price to an all-time high, rocketing its market cap past the $1 trillion mark. Here with what may be ahead for the chipmaker, as well as other investment ideas, our friend Nancy Tengler, Laffer Tengler Investment CEO and CIO. Good to see you, Nancy.
You too, Julie. Thanks for having me.
So we thought of you because Broadcom is one we've talked to you about before. So I'm curious how you're thinking about it these days after the big surge that it has had.
Well, thank you for remembering that. Yeah, I think we've talked about it as the poor man's NVIDIA. I think it graduated with the guidance we got on AI from Hock Tan. We had been trimming in the summer because it just got to be such an outsized position. Early July, we were trimming back, and we will probably have to do so again. It's the largest holding in across all of our large cap equity strategies. But I think at this point, you still want to own the stock, and there probably will be a pullback after this big surge, and then you'll get another chance if you don't own it to own it. But I think this is a stock you want to own for the long term. They raised the dividend 11%, which is below historical growth rates of 15%, but they're using the free cash flow to pay down the debt on VMware. And this is just a really well operated company. And Hock Tan has taken two big acquisitions and made them accretive within a year, and that was CA Technologies in 2018, and then VMware. So I think we really want to continue to own this name because the AI spending is not over. I heard somebody say today it's going to slow down next year. It's not, and this is a classic example. The guidance we got today.
Well, that's what I wanted to ask you, Nancy. When you read this report, you saw the results. You listened to CEO Hock Tan on that call. I'm just curious, what were as an investor, what were the bigger trends you took away about this mega AI trend?
Yeah, well, Josh, we've been walking around the office today saying Hock Tan is the man, because he really did have some magic bullets he pulled out, because the report itself was not that great. It is the 18th quarter that they've beat on EPS, but the revenues came in, I think, a little bit light. Semis grew 12%, but that's because AI semis grew 150%. The traditional semiconductor business was down 23%. So, but up from the bottom, up 10% from the bottom. So they think that the traditional business is sort of has bottomed and is now on the recovery. But the guidance was unprecedented for AI, 60 billion to 90 billion in new revenues by 2027. And that's just from existing customers. They have two very large data center customers that they're just kind of onboarding, if you will, and they haven't even begun to ramp that into the revenue guidance. So I think, it's just done a great job in the software business. Infrastructure grew 196% year over year. So there's a lot going right at this company. At some point, that may stop, but not for the foreseeable future. So I think this is a stock you want to own for the next 2 to 3 years at least. And
Nancy, obviously one of the other notable things about the push higher today is that it got to that $1 trillion mark, right? And we were looking, our team, at some of the largest companies in the S&P 500 now, because we have a number of companies in not just the $1 trillion club, but like getting up to the $2 and $3 trillion club here. So I'm curious if there are any others that you are watching next year that you think are going to get to that club as well, to get to that $1 trillion club.
Yeah, well, it's a guess, right, Julie?
Sure.
But one of our names that we've loved in our investing theme is an old economy company that has pivoted to all the new technologies, and that's Walmart. It's at about I was just looking at it, $760 billion in market cap. It has room to continue to appreciate because they're using generative AI, digitization, robotics to really bring margins up, and they've indicated their confidence by raising the dividend 9%. That hasn't happened in at least a decade, and I think we will continue to see their advertising business grow. So it is possible. I don't know if it'll happen next year, but I think at some point we'll be adding that Walmart to the $1 trillion club.
Nancy, I want your take on NVIDIA as well. It has been a bit weaker here recently, Nancy. We're down about roughly 10% in the past month. I'm just curious your take on what you think is going on there. Is Is that just, we're in a transition period here between product cycles for Jensen Huang? What do you think explains it?
I think the market has a very short attention span, Josh. We just added to it actually yesterday or the day before. I think one of the things you have to think about as an investor is these things consolidate and then they take off again. All you have to know is the Blackwell backlog. And to me, that tells the story. They beat on every metric last quarter. They just didn't beat by as much as they have been. Still incredible earnings growth, a PEG ratio of just over 1. So I think this is a company that you have to believe that spending on generative AI is going to drop off a cliff, to not anticipate that the stock will go higher from here. So we have used the weakness to add to it. We added in the summer. I think it got down in the high 90s. We added in the low 100s, and we'll continue to do that because we think this is also a name that you want to own for the next 3 to 5, maybe 7 years. ServiceNow CEO just came out and said, and that's one of our 12 best ideas. He came out and said that generative AI spending is going to be $20 trillion by 2030. Now, who knows if he's right, but he doesn't have to be, you don't have to be far off. Even half that would be remarkable. So I know there's a lot of people coming out and saying AI spending is slowing. We're not hearing that at company levels, and we sit on all the calls at our company.
Nancy, always great to see you and have you on the show. Have a great weekend.
Thank you so much. Good to see you guys.
All right, let's get to some calls of the day now. Needham upgrading Upstart from hold to buy. The note pointing to better findings and a stronger balance sheet. So Needham does like this one now, Julie. The target, a street high of 100 per Bloomberg. Average, by the way, is more like 61. Likes the AI lending marketplace, says it has continued to onboard and scale committed capital partners, which we view as crucial towards having more visibility in the model versus selling primarily to at-will partners. Also did talk about that balance sheet, which he said sort of transitioning from an overhang to a point of strength.
This stock has doubled already
it's
this
huge.
year.
It's 115%, something like that this year?
Yeah, and not everybody's on the same page on this, in part as we have seen that big surge. I mean, there are pretty evenly split between buys, holds, and sells on this stock. About a quarter, 5. We've got 5 buys, we've got 7 holds, we've got 6 sells.
After a move like that, look at that chart.
It's unusual to see the street as divided on a stock.
It's a battleground stock, Julie.
Ooh, I like that. Yes, it is. Yeah, I know you didn't, but I still like that. I haven't heard that in a while. All right, and Goldman Sachs also initiating coverage on some beauty names, including e.l.f. It's initiated a buy. The analysts there calling it one of the fastest growing and most disruptive players in beauty, and those shares up 6.6% on that. And the analyst there, Patty Canada, is initiating coverage again on this industry as a whole. Calling e.l.f. as a small, more nimble challenger to incumbent beauty brands.
Yeah. Particularly called out what's going on overseas. They say we see additional upside internationally. Believe the significance of that opportunity is underappreciated. That was part of it.
And also, by the way, Coty initiated at a neutral in that same note.
Oh, so not as big a fan.
No. Let's talk about Wolf Research also upgrading PayPal from peer perform to outperform. That note highlighting the stock's upside potentially in 2025. Would we describe PayPal as another battleground stock, perhaps? I feel like this is also one that people are sort of divided on.
We can't overuse it, Julie. I can only use that once a show.
Okay, fine. All right. I got excited. This one, too, though, it's also evenly split between buys and holds. But here, the analyst likes the user base, 220 million active users, and that there's some other near-term catalysts that might be good for the company. $107 is the price target on this one.
Target's 107. Talks about streamlining focus, managing expenses, returning capital to shareholders. So heading into next year, what do they see? They talk about room for upside, given the potential to deliver a cadence of beat and raises as PayPal execute on its branded checkout innovations they talk about, pricing the value on Braintree and Venmo monetization.
Yeah, and they've had a good year this year already. The shares up
50%,
almost 50%, yeah.
All right, with Netflix stock now above $900 a share, some on the street believe a stock split is imminent. And our next guest is one of those voices. Joining us now is Ken Mahoney, Mahoney Asset Management CEO. Ken, it's good to see you. So listen, we've had an incredible run right here in the market. No surprise, there's probably a lot more names in that triple-digit category. So that means what, Ken? More splits on the way?
Yeah, Netflix is used to this. They did this back in 2004. They did it in 2015. 900 something. I mean, look in the video. Remember in the video this past summer, June 10th, they did a 10-for-1 split. The stock was like $1,200 a share. I know you could buy fractional shares, but people don't want to buy fractional shares. I want to buy 100 shares of NVIDIA at 120. So there's a good precedent that once a stock gets over 600, in this case, Netflix over 900, to do a split. And by the way, after NVIDIA did their split in June, you remember just a few months later, and now back in November, they got added to the Dow Jones Industrial Average. Hint, hint, Netflix, maybe you can be part of the Dow Jones Industrial Average, that prestigious group of 30 stocks.
So Ken, is there anything sort of, when you're looking at stocks that could potentially split, is there sort of a formula that you can apply, or is it more just like a sort of gut feeling that's also based on patterns for the company in the past?
Yeah, I think it's more, first off, it's a good sign. Look, a reverse split is just the opposite. They take shares away from you. I'm reminded like 1990s, you start off with, let's say 100 shares of Microsoft. By the end of the decade, you had 1,600 shares, 100, a 2-for-1, 400, 2-for-1, so forth. So a lot of investors like that. I think you start getting over $500 a share. Institutions don't mind, right? They buy and they buy percentages and they overweight, underweight. But for most retail investors, I don't know, starting past $500 a share starts feeling like they should be doing some type of split, and something that's easier to digest. So again, I don't have a specific formula than say probably over $500 a share, but for the companies that want to get into the Dow Jones, remember that's price weighted, which is kind of wacko, which means you cannot put Netflix as a Dow Jones component at $900 a share because it would overweight so many other stocks are trading $120, $150 a share.
I wonder, Ken, for viewers who are listening out, I mean, I just wonder if there's any actual research that would tell me, okay, a split, long term, 3, 5, 7 years out leads to outsized returns. Because my guess would be, Ken, it probably doesn't, because the optics don't change the fundamentals. It doesn't change what you're earning, the PE, right?
Right, and that's to be said. So when you do a 10-for-1 stock split, the example I gave in the video on June 10th, you had 100 shares at $120, $1,200 a share, and then he split it. Okay, so great, but you're right. On that same day, the market valuation did not change at all, right? Even though it felt good to have more shares. But again, for a stock to be able to split consistently, I also kind of think that the earnings are pretty strong also. I mean, you can't split a stock at $45 a share necessarily for the stock to go higher. But again, I'd like to see that report as well, my friend, to see what that looks like longer term. It may not have a lot because it has a lot to do with earnings, as you suggested, and buybacks and supply demand of a stock and a sector and so forth. So maybe stock splits don't have enough, but it does bring a different crowd. I mean, even in the video when they did their split, they said, we recognize we'll bring a new crowd of investors which are not going to buy the stock at 1,200. So that's still worth doing something for good PR for the company to recognize it's out of reach for the average investor, and for the company management to say, like Netflix, also we think the next few quarters during their earnings conference call, they're going to split the stock. My guess, it's just a guess, 10-for-1. So instead of $900 a share, $90 a share.
Are there any other stocks that you're watching right now as potentials here, Ken?
I think Meta's up there 600 and change. Microsoft has a strong history. They're 440, 450. So those are the ones that kind of stick out. The biggest one this year, obviously, was Chipotle. I mean, a 50-for-1 stock split. You had to sit there with a calculator to figure that out. And that was trading around 3,000. That was kind of out of reach for a lot of investors. So I do like the idea, and I get it on the same day, it's the same valuation. And for all we know, when you look at down the road, there is no correlation between stock splits and overall performance. But the average investor feels like they're shut out of some of these institutional-like holdings. But my next one would be Meta, and maybe perhaps Microsoft right behind that.
We'll be watching, Ken. Thanks so much. Okay. Appreciate it.
Splits.
Shares of Costco higher today on the back of its latest earnings report. Yahoo Finance goes beyond the ticker to take a deeper dive into the history of the big box retailer.
Costco set the precedent for membership-only models back in 1983. But what led to such success for the more than 40-year-old retailer? Beyond the Ticker takes a deep dive into the company's biggest moments. Back in the 1970s, entrepreneur Sol Price opened the first ever wholesale retailer under the name Price Club in Southern California. In 1983, Jim Sinegal and Jeff Brotman opened the first Costco warehouse location in Seattle, Washington. A year later, the iconic Costco hot dog was introduced. With the fixed price point it still has today, $1.50. In 1985, Costco went public at $10 per share. At the time, the company had 17 locations. In 1993, Price Club and Costco merged. And until 1997, it was called Price Costco, until it took on the name we know it as today, Costco. In the mid-90s, Costco introduced its private label, Kirkland Signature, named after its original headquarters in Kirkland, Washington. That business now worth $56 billion. In 1997, the company launched its e-commerce platform, Costco.com, bringing its low prices and services online. By 2014, Costco was the third largest retailer in the United States, with sales exceeding $110 billion and a net income of over $2 billion. And its presence and loyal membership-only model keeps growing, giving it the ability to raise its membership in 2024 for the first time since 2017, from $60 to $65 per year for 3 of its membership models. As of 2024, there are nearly 137 million members and 891 stores across the globe.
Yahoo Finance has been releasing its coveted annual Company of the Year award since 2014. We'll reveal a winner in the following categories: Company of the Year, Surprise of the Year, product of the year and comeback of the year. Be sure to tune into Yahoo Finance starting December 16th for the big reveal. Trust me, you won't want to miss this stuff.
The auto market has been in a tough spot this year as affordability issues weigh on the sector, including inventory challenges. While looking ahead to 2025 for the auto space, the load of challenges, well, it's not necessarily looking any lighter. Car Guru U.S. Director of Industry Insights and Analytics, Kevin Roberts, joining us now to discuss here. So as we look at some of the big themes of 2024, is affordability the one that kind of trumps everything else?
Yeah, I think affordability was kind of the throughput trend for 2024 for the auto industry. We definitely saw consumers, after kind of years of revenge spending coming out of COVID, pivot pretty hard to affordability this year. And it really came down to high vehicle prices and interest rates at multi-decade highs really kind of increased those monthly payments for consumers. And that led to kind of trickle-down effects for the greater industry.
Kevin, I want to spin forward into 2025. Start with Trump moving back into the White House. That means tariffs front and center. How are you thinking about that policy, potential ripple effects, impact on the U.S. auto industry?
Yeah, much is uncertain at this point. So we've done analysis on it. If you look at the end of November, roughly over 50% of listings on our site were from U.S. built vehicles. So you could say roughly over half of inventory would be, removed from those. So it really comes down to where would tariffs be impacted, what countries would they go into effect, and really whether they happen immediately or if there's a little bit of forewarning for the industry. I think if there's forewarning, the auto industry is very adaptable and can move around and kind of reallocate resources. But if it goes into immediate effect, that's where it'd be a little bit more disruptive for the industry.
So that could affect sort of flow of inventory, sort of pricing as well. And then something else that could affect pricing is the whole debate over EV tax credits. We know how Donald Trump feels about them. We know how Elon Musk feels about them. How do car buyers feel about them?
I mean, the tax credits are definitely a benefit for consumers right now, particularly as EVs tend to be higher priced than comparable hybrids or internal combustion engine vehicles. So the loss of tax credits would definitely be a headwind for the industry in 2025. And it's important to remember that's both on the new side where there's an EV tax credit and also on the used side. There's a $4,000 used EV tax credit for used EVs under $25,000. And at the end of November, about a third of used EV inventory was priced under that price point. So that's another headwind that we could see for EV adoption in 2025.
But let's say, Kevin, that the credit disappears and I'm a consumer, I still want that EV, that plug-in hybrid EV. I'm looking for a relatively more affordable option. What would be some of my choices?
So where we've seen a lot of prices come down is actually in the used EV side of the market. Like I mentioned, over a third of used EV inventory was under $25,000. And we've seen a lot of interest in those used EVs out there. It's also important to note that a lot of automakers are bringing more and more new EVs to the market price, and they're starting to bring down the prices quite a bit as well. So we're starting to see starting prices in the 30s and 40s on a lot of these new EVs. And so that, I think, will help to drive adoption, even if we have the tax credits go away.
What's sort of the big picture for where sales are going to go this coming year?
Yeah, so we're currently expecting relatively moderate growth for both new and used sales in 2025. Again, that is, a baseline forecast assuming relatively no tariff adjustments and tax credits continuing on. And so any of those shifts could shift where we see forecasts going at this point. But the industry still continues to recover from the semiconductor shortage, and we're seeing prices start to moderate on vehicles. And again, we're looking at interest rates starting to come down as well, which should help drive further demand in 2025.
What about finally, Kevin, auto delinquencies? I know you all point out auto loan delinquencies on the rise. I'm just curious how you see that developing into next year.
Yeah, it's a trend we're keeping an eye on as auto delinquencies get back to more natural levels. They were pretty depressed with the amount of COVID stimulus that was out in the marketplace. What I'm really keeping an eye on is the loans that were originated in 2021, 2022, when vehicle prices were at their absolute peak. We could see a large number of consumers who might be underwater on those loans now, above what kind of long-term trends are. And if delinquencies start to rise on those loans in particular, keeping an eye to see what happens and if we might see a higher rate of defaults there.
Will there be any kind of pivot or move to higher priced vehicles next year?
It's something we're also keeping an eye on. U.S. consumer generally likes to kind of stick with their long-term trend, which is, larger trucks, larger SUVs, higher priced vehicles. We've seen them pivot towards more affordability in 2024 with those interest rates high. But as interest rates start to come down, we could see consumers start to go back to their, true loves, which is those larger trucks and SUVs. And so we could see a little bit of rebound in higher priced vehicles in 2025.
Kevin, great to see you and have you on the show. Thanks for joining us.
Thanks for having me back.
And while wrapping up today's market domination, don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains, where for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
There's the closing bell on Wall Street, and now it's market domination overtime. We're joined by Jared Blicker to get you up to speed on the action from today's session. Let's start with the major averages on the day. We've got the Dow down by about 0.2%, about 86 points here. The S&P 500 very, very little changed, and the Nasdaq up 0.1%. But the theme really of the day and of the week has been the reversal of the broadening trend, right? So you see that today, for example, with the S&P 500 little change, but the S&P equal weight down about 0.4%, and you saw that on the week as well. So the S&P equal weight down 1.7%, but the S&P 500 down just 0.6%. And again, that's because of the relative outperformance of the largest stocks, and in particular, the mega cap tech trade. So we've seen that play out over the course of the week, and it's been interesting, especially since it has been contrary to what investors have been calling for. We'll see if that changes in the new year. Jared's got a closer look at today's action.
It's been a fascinating week. It's been a fascinating 2 weeks. I'm going to dive into some of this with Josh in a couple minutes. But first, let's take a look at the Dow. The Dow is down 7 straight days. We have not seen this since the end of February of 2020. Let me just give you a 5-year chart, because that was right before the pandemic meltdown. And I'm not saying that I would expect that to happen again, but there are some interesting things going on in the market. We have seen short-term rates, and that would be very like the 13-week T-bill. Those have been dropping as longer-term rates, like the 10-year yield seen here, have been increasing. It's up 7 basis points today. And what's interesting, too, is that financials have not been able to capitalize on that. But let's take a look at the sector action for today. It's been about the mega caps. We see tech and consumer discretionary. Those are the 2 winners today, up 0.4%. Not a lot. Communication services, also a mega cap sector with Alphabet and Meta. That's down more than 1%, the worst loser there. Materials also notably off by 0.8%. Materials has been on a 10-day losing streak, and that's been as the dollar has been rising. So I'm going to dig into that with Josh too. But let's go to the Nasdaq 100, where we see Apple eking out a small gain there. Tesla, a nice another record close, or it should be. Broadcom up 24%, but what's really standing out is all the weakness, especially in some of the larger names. December has been about the mega caps. Not today, not yesterday. It's been risk off. So with that, I'll send it to you, Josh.
Thank you, Jared. For more on today's market action, let's welcome in now Timothy Chubb, Chief Investment Officer at Gerard, a Univest Wealth Division. Tim, it's good to see you. So it has been a great 2024, and you sound fairly optimistic, Tim, as we head into 2025. How come?
Yeah, optimistic, but at the same time, we just came back from 2 back-to-back, 25% gain years, and we're maybe not in bubble territory, but there's not much multiple expansion that can go, further. But as you're just discussing, we expect next year that actually see the broadening out take place as we start to see various sectors that have really been in a lull, earnings growth meaningfully lower than the Mag 7 actually start to catch up. And we still think the Magnificent Seven can do well next year. We're selective in so far as overweights and a few omissions, but more broadly, as we kind of go down market cap a little bit into the mid caps and look at some of the other beneficiaries of the AI spending cycle, ultimately, I think there's going to be pretty nice upside to earnings next year, and ultimately that should drive a bit of rotation under the surface.
Tim, what needs to happen for that broadening to take hold in a more decided fashion? We got like a little bit of fits and starts there, and it started to happen and then it stopped. What would make it more sustained, do you think?
Yeah, absolutely. It comes down to the relative earnings. And so if you look back the last 12 months, I think the annualized pace for the S&P 500 has been somewhere in that 7.8% range. But if you strip out the Magnificent Seven from that, it's closer to 3.7. So, we've had back-to-back 25% gain years in the S&P, but we haven't had earnings growth to follow. It's been lots of multiple expansion. If we start to see the earnings growth come through in those other sectors, I think that's where we would start to see perhaps maybe not the Mag 7, not doing nearly as well, but not we expect them to do a bit. I guess the rest of the 493 that have certainly lagged behind to sort of catch up with that a little bit next year.
Tim, let's look into next week. Big Fed meeting on deck. I know investors are betting on that cut. Do you think that's a slam dunk, Tim, after the inflation readings we got this week?
I think it's a slam dunk. The Fed has really said, the balance of risk has changed, and now the labor market is what exceedingly more important. And after the readout that we got last Friday, we're really seeing the Trump administration sort of inheriting an economy that's been slowing. I think it's reasonable to expect that growth may be a little bit more above trend for next year. But a labor market that's softening as well. And so, it seems like wage growth is in check. It seems like we really have, had this softening and thawing of the labor market after, a wild couple of years. But ultimately, jobless claims, or at least continuing claims, are up about 5% in recent weeks. And so there has been some softening, and I expect that to flow through into, the December jobs report as well. So, I think a cut is locked in for next week. But it's really anybody's guess, as to how much further they have to go. I wouldn't be surprised if the Fed pauses, and I'll be curious to see, what their updated terminal rate may look like in the summary of updated economic projections.
Tim, from an investing perspective, what are you excited about for 2025? What are you thinking that, maybe an investment theme that people are missing, a sector? What's getting you jazzed about next year?
Yeah, it's a lot of the reports, and everybody's got their outlook out right now. A lot of it is just an extension of what we've been experiencing here within the last 3 months. We really think here in the U.S. we'll continue to see sort of that secular exceptionalism take place, but you have to put into perspective, I guess, where we're at in the economic cycle, and there's been so much economic disaffection that put Trump back into the White House, and so. We're cautious on some of the more economically sensitive and I guess fading some of the rally that we've seen from some of the lower quality companies here post-election. It's tough to get really excited about the healthcare sector with a lot of the regulatory overhangs and other policy fog that's out there. But there are spots. And so Broadcom was a good example of an area that we've really been focusing on. We think the ASIC custom move is likely to continue and accelerate. And that's been an area of our focus that we've been really excited about, and other beneficiaries as we kind of go into that next phase of the AI cycle. Beyond that, it's really adjacent sectors. So within industrials, data center maintenance, within utilities, ultimately powering this AI boom. And so there's a lot of concentration within the AI theme, I'd say, within the portfolio. It's just looking a bit under a few more rocks and having a broadening out. And we think that's going to follow through with earnings growth next year.
What about fixed income investors, Tim, who are listening right now? What's your advice?
Yeah, fixed income, it's a tough spot. I spent most of my morning working on some changes to our strategy. Spreads are tight, and I don't think fundamentals are going to really deteriorate much. If we get another 50 to 100 basis points and high yield spreads backing up, I think that would be a good buying opportunity, and it'd be something we'd be looking to take advantage of. But for the first time in a long time, rates look a bit more attractive than spread product right now. And so I think it's really important to have an idea of, A, what do you want your duration to look like relative to the ag? We're currently in a neutral position, but we have a little bit more convexity, and it's trying to cut off some of those tail risks if the economy were to decelerate a bit more meaningfully ultimately. And so it's, I guess, shifting into neutral has been a big theme, and building up that core position. But I wouldn't be surprised if fixed income really has a clipping the coupon type year next year, as opposed to sort of this rapid cutting cycle resulting in double-digit gains like we've seen in the last 12 months.
Tim, thanks a lot. Good to see you.
You too. Thanks.
Well, President Joe Biden says he's leaving incoming President Donald Trump a booming economy. Maybe, maybe not. Joining us now, Yahoo Finance's Rick Newman. That was obviously the message of the Biden administration and the Biden campaign that then became the Kamala Harris campaign, but people weren't really buying it, Rick. So what now?
And Biden gave a speech this week that I think nobody paid any attention to because it was all the same talking points, and these guys are on their way out. But I mean, it's a great question. I mean, we just heard a guest saying, we actually have a slowing economy, and yes, the Fed is probably going to cut 1 more quarter point next week. But if you look at inflation, I mean, there's something interesting happening there. Goods inflation is basically not a problem anymore, but services inflation is a problem. And that includes rent, that includes insurance, which we've been covering a lot this year. That includes medical services. It includes personal services, haircuts, dry cleaning. And I've just been going through a lot of those categories. Those inflation there is 4, 5, 6, 7, 8%. For auto insurance, it's 12%. And it's not clear that that's actually going to get better. So we could have inflation kind of ticking upward as Trump takes office. Trump is threatening things that would be inflationary on their face, tariffs, for example. You also got to wonder, the stock market has been fantastic. I just did the numbers a while ago, up 68% over the last 26 months. I mean, that's spectacular. What if that's a bubble that bursts? I mean, who knows? Nobody knows where all this is headed. We're not going to have a recession in the next 2 months. But a year from now, it might look like what Trump inherited was an economy that was rapidly cooling off.
This relationship, Rick, between tariffs and inflation, dig into that a little bit more for me, because it's interesting. I saw Scott Bessent, who's going to be our next Treasury Secretary, at least Trump's nominee. He recently wrote, Rick, that President Trump's first-term tariffs did not, in his words, raise the prices of the affected goods. But I know you've dug hard into this subject, so break it down for us.
Yeah, well, it's important to pay attention to what Trump actually did during his first term. He did not impose tariffs anywhere near what he threatened when he was running for president in 2016. I mean, just one way to frame it. He said he would consider tariffs as high as 45% on all imports from China, but the tariffs he actually imposed ranged from 7.5% to 25%, and that was only on about half of all imports from China. And the strategy there was very obvious. They did not put tariffs on retail goods, finished retail goods, so they put no additional tariffs for the most part on clothing, phones, electronics, any stuff that would go straight to consumers, because they didn't want consumers to see, wait a minute, suddenly this is 10 or 15% more expensive. They put those tariffs on intermediate goods, components, so those were things deep in the supply chain. And what actually happened is manufacturers found ways to get around raising costs by very much. One of the things we know they did is they started importing a lot more stuff from Vietnam, no tariffs, instead of stuff from China. So if for Bessent or any Trump apologist to say, oh, we did tariffs once and it didn't affect anybody, well, that's because everybody found workarounds. And what Trump wants to do now is he talked about a universal baseline tariff on all imports so that there are no workarounds. Now, I'm not lighting my hair on fire over this, because I think Trump actually is not going to do a lot of the stuff that he threatens. I think we learned that from before, so maybe this will not be much of a factor. But if Trump says what he does, he's going to put a tax on goods, which makes the price go up on its face, and that raises prices.
Rick, always good to see you. Have a great weekend.
Bye, guys.
And be sure to scan the QR code below so you can catch the latest episodes of Rick's podcast, Capital Gains. That airs every Friday at 12 p.m. Eastern. Here's a look from today's episode.
If the adults in the room don't act like adults, then the capital markets are going to discipline them, and that's going to be through interest rates. And so what we're suggesting right now is that I can imagine mortgage rates go down a little bit in the next year or two. We're definitely not going back from 7 to 3%. At the same time, 7% would cause some pain. 9% double digit. I think that is where maybe interest rates have to go before politicians do respond. But it is going to be very challenging on younger people trying to buy a house going forward if these interest rates don't come down. And if they don't do anything, we're projecting that interest rates literally have to go above 15% within a decade if we just keep on this current path.
As the year's end approaches, the Santa Claus rally may be on its way for investors. And while that might be the case, our next guest says the options market is pointing to a cautious tale for investors when looking beyond the surface. RBC Capital Markets equity derivative strategist Amy Wu Silverman joining us now in our options playbook, sponsored by Tasty Trade. Good to see you, Amy. So, at this time of year, definitely people's thoughts turn to that potential Santa Claus rally at the end of the year. What are the signs you're looking for in the options market as to what direction things may be going?
Yeah, good to be here. So obviously, we really don't have that many weeks left until the end of the year. And look, it's really just about a positioning trade, I think, for the end of the year for most folks who have done well this year. Honestly, it's about not rocking the boat. And of course, that reset, which will happen in 2025, is a different story. The options market right now is fairly complacent into the end of the year. You see that in the spot VIX kind of floating at this 13 handle. But when you think about term structure, so just the forward expectations for option prices, for volatility, we do see a little bit more uncertainty as different, variations of tariffs are enacted or different policies as a new president comes in. And I think that's why we see a little bit more expectations of future volatility.
Amy, spot VIX, I know, subdued, but what about VIX futures? What are you seeing?
Yeah, spot VIX is really floating around that 13 level, and the low for this year was about 10.5. So, we're really quite there. But when you look to the future, both for S&P implied volatility term structure as well as VIX futures, it's relatively steep, particularly in the 3-month, 1-month space. So just meaning when you look 1 month out versus 3 months out, how big is that premium? It's fairly steep. And again, it suggests that there is a little bit, not only more worry in the future, I think there's just more question marks about what are the right trades to deploy as we reset, get into a new year. You have this in the back burner, obviously a good year for the S&P, but then you face a whole new year when you've had 2 solid years of S&P returns.
Amy, you also brought up the great image of the paddling duck, that on the surface, the duck is gliding along very gracefully. You look underneath the water and you see those fin flippers, I guess, paddling furiously. Is it mostly sort of around policy that we see those kinds of moves, that kind of churn under the surface?
Yeah, the reason I like that analogy is exactly that. What you see on the surface is not necessarily what you see beneath. And I'll just give you a really simple example of how policy has impacted that, Julie. If you think about when the cabinet picks came out, so just looking at how RFK negatively impacted the healthcare sector, but how when you look at financials, how that was quite positively impacted. So obviously they both had violent rotations, though both had large moves, but in some ways, they canceled each other out on an index level, and that's how we get that calm paddling duck. And I think to some degree, S&P volatility and VIX is a little bit deceptive because it's telling you what the index level volatility is, but it's not telling you how violently we did rotate when we did see those policy implications.
Another way to describe this, Amy, is a market with high dispersion. High dispersion suggests what for traders and investors listening right now?
Yeah, and the reason I've liked using this paddling duck analogy is I think this is something we've experienced now for a few years in this market where high dispersion, a simple way of thinking about it is it's really a stock picker's market. It's really a place where active investing matters, relative to passive investing, because again, you can't just say carte blanche, I'm going to take all these sectors. It really made a difference if you were all in on financials, for instance, versus healthcare, because obviously there were these idiosyncratic impacts. I think when government policy comes to play, as it will in 2025, as we've clearly seen, that dispersion will be high. So where you place your cards, if you will, is going to really matter. And that's why it kind of matters that it's a stock picker's market.
Amy, it's also interesting how negative breadth has been as of late. I've seen a lot of notes about that. One of them came to us from Bespoke, and they noted that the S&P 500 decline advance line was negative every day of the month so far. Now, by their reckoning, that means we're maybe a little oversold here. What is that telling you?
Yeah, the market's breadth has been very bad, very stinky, right? And it's been, the same folks who've been carrying us, the same mega cap weights have really determined, the return of the market. I think two things here. The first is when you think about next year, because the weighting of the market matters so much, we really can't have the AI trade or the mega cap tech trade or the Mag 7 fail. It has to be at least okay. And then second, if you want there to be kind of a healthier market, you really need to have that widening occur as well. But one cannot be bad, even if two is good, because, as you'll see, it becomes that weighting that really interplays into the market. I would say, one thing the options market is telling us right now is we're not really seeing full kind of positive sentiment about breadth widening. We have seen that in fits and starts in the past with IWM call skew essentially telling you people are bullish on that small to mid cap range. We've really seen that recede in the market. I would watch that as an early indicator if we think breadth widening will start next year.
It's your job in the options market to sort of prepare for eventualities, to hedge, as it were. One of the ways you're looking at a potential hedge is energy call spreads. Why is that a place that you're looking right now?
Yeah, it's a little tricky. And the reason I say it's a little tricky is if you've kind of looked at the market when kind of bad geopolitical things happen, it hasn't really impacted the S&P. If anything, the S&P has sort of been your flight to safety, Julie, because people keep going back to these mega cap tech Mag 7 names, but that doesn't mean there aren't these relatively fat tails under the surface from geopolitical risk, anywhere from the Middle East to South Korea to Europe. We see all these major events happening politically. And so one thing investors have had to do is be a little bit more clever about their hedges. When they see correlations rise, it may impact the energy sector, obviously from a commodity perspective in the Middle East, but it may not necessarily impact S&P. And that's why I think something like energy call spreads helps you with those geopolitical risks that may not feed into the S&P as it used to.
Amy, always great to have you on the show. Thanks for joining us.
Thank you.
Well, Warner Brothers Discovery reorganizing its business into two separate units, one for linear and the other for streaming. This coming against the backdrop of a second Trump presidency where the regulatory landscape for big media names could shift significantly. For more, we're going to bring in now Jason Bazinet, Managing Director at Citi. Jason, always good to see you. So let's start there, Jason. Trump coming back to the White House, lots of questions about what exactly that's going to mean. It's introduced some policy uncertainty, but one bet, Jason, a lot of folks have made is that is going to impact sort of the broader regulatory backdrop, the regulatory environment. It's going to get friendlier. If that is the case, Jason, that means what for your coverage universe, for media companies, the media industry?
Well, we spoke to a number of media executives during the course of 2024, and they essentially said that M&A was just off the table. They just really weren't willing to entertain it, under the DOJ and FTC regime that was in place. And so, what does that mean? I think it just opens up a whole degree of optionality that exists for these media companies, and for some of them, it means going on offense. Others, it means maybe playing defense, but certainly restructuring the assets in a way that's probably more intelligent.
Well, and Jason, would you say as a whole that the media industry is sort of on weaker footing than it was during the first Trump administration?
Well, I guess if I went back that far, in 2016, the media companies were essentially unaware that cord cutting was going to sort of take hold. The epiphany really occurred in 2017, and it took them about 2 years to complete the M&A to position themselves. That's when we saw a whole flurry of M&A. And the thesis at the time was the media companies were trying to get enough content firepower in terms of spending underneath one roof. And so you saw a lot of consolidation that happened during that 17, 18, 19 period. What happened during the Biden administration is everyone leaned into their streaming app and discovered that it's a lot more difficult than they thought. And so now we're sort of in, I would call it chapter 3, which is now what?
Well, and in this chapter, I guess what I'm asking is, because of that rejiggering and repositioning, all things being equal, that maybe there is less of an antitrust threat from some of these guys teaming up because they're not in as strong positions, if that makes sense.
Yeah, I'm not, well, let me back up. I mean, I don't really think there is a very formidable antitrust case that you could make because none of these companies are really dominant.
Right.
What the Biden administration was really trying to do was to rejigger the rules such that we moved away, in legal parlance, from the price theory of competition, which is what undergirded all of antitrust law in the US for the last 40 or 50 years, to something that is called structuralism, which just says big firms are bad because they're big. And so we're just really going back to the old ways of doing things. And through that lens, it just means that everyone understands the rules of the road, and therefore that's going to open up more M&A possibilities.
Jason, some news in your coverage universe this week I want your take on is Warner Discovery to restructure. Jason, does that set up, in fact, the kind of deal making we're talking about here?
Well, yeah, I think the buy side understands that these traditional media companies need to rationalize. And the thing that they want to see is really a rationalization in the number of apps. They want fewer apps out there with the idea to put more content under fewer apps and reduce churn. What the buy side has been struggling with as it relates to Warner Brothers is who's actually going to buy it. And the thought is that Comcast would be the most likely buyer, but what Comcast had been pretty clear messaging is they weren't really interested in buying more linear cable channels. They didn't want more of the declining assets. And so when Warner Brothers stock took off, it's when Comcast announced that they were going to spin off their linear cable channels. And the way the buy side interpreted, I think, is correct, which is you marry that move by Comcast with the announcement yesterday that Warner Brothers is splitting into a cable nets business and then its studio and app on the other side. And it really, I think, just lays the groundwork for what I'd call a big cable net company that will struggle with the top line, but it will be what it is. And then you can have essentially the studio of Comcast and Warner Brothers come together, Max and Peacock come together and take the Warner Brothers IP and use it in Comcast Parks, Universal. And that just sets it up where it's sort of the right sort of acquisition for Comcast. And that's how the buy side's interpreted. And I think that's exactly right. So.
And Jason, finally, I guess, aside from all of this, it's interesting that your top picks don't really have to do with all of this business, right? They don't necessarily have to do with the changing landscape or combinations or whatever. Let's talk about Take-Two, I guess, to close you out, which is a video game company. So they don't have to deal with all this stuff, right? And
right.
Basically, you're awaiting, like many people, the release of Grand Theft Auto. Do you think that both timing-wise and magnitude-wise, it is going to meet expectations?
Well, the magnitude one, I think, is easier to answer than the timing one.
Yeah.
So on the magnitude, GTA 5, which came out in 2013, sold around 30 million units in the first year. Buy-side expectations are around 35. Some people are at 40 million. I think that's, beatable for sure. So I feel quite confident on the unit side. Why do I say that? There's 25 million people that are playing GTA 5 online now. And so to say you're going to sell 40 million units or something north of that seems very achievable to me. The timing question is a little bit trickier because, as many of your viewers know, Take-Two doesn't release games unless they're perfect. And so they, delayed the old GTA 5 3 times. They delayed Red Dead twice. So, and we've only had one delay so far. So there's a little bit of a risk there on a delay. What's interesting is when I speak to institutional investors, they don't think the stock is going to retrace all the way back down to 135, which is where it went during the first delay, just because they think it's sort of closer and the business is in a better position because of mobile. And so I still think it's actually a really interesting risk reward here.
Jason, always great to see you and have you on the show. Have a great weekend.
Thank you very much. You too.
Time now for what to watch next week. It's that time of year again, and no, not the holidays. It's the Fed's last interest rate decision of the year. The two-day FOMC meeting beginning on Tuesday, with the Fed's decision coming on Wednesday. Fed Chair Jerome Powell is holding a press conference after the decision at 2:30. Yahoo Finance's coverage of the decision will begin at 2 p.m. Eastern on Wednesday.
And taking a look at earnings as well, we'll be getting some big names reporting next week, including Nike, Micron, as well as General Mills. Nike will announce results for the second quarter after the closing bell. Analysts expect the company's second quarter sales to dip, and investors will be listening for commentary from Nike's new CEO, Elliott Hill, as well as early reads from holiday sales.
And moving over to the economy, monthly PCE data, that's personal consumption expenditures, coming out on Friday. Economists forecasting the Fed's preferred inflation gauge to hold steady for total PCE at 0.2%, while core PCE slows to 0.2%.
Well, from AI to CPI to China probing NVIDIA, it's been an eventful week here at Yahoo Finance. Here's a look back at what you may have missed over the past few days.
Month-over-month CPI number coming in line with expectations, a rise of 0.3%.
We have an environment in which we're not seeing any acceleration in inflation.
The market is really questioning whether or not the Fed can get to that 2% number.
From the Fed's point of view, the unfortunate thing is that it does show we've had sort of a stall out.
Nobody should be surprised to hear about an ongoing set of probes against NVIDIA, especially coming from China.
I do think it's primarily a political message.
If you want to get Donald Trump's attention, hit the biggest stock.
Maybe the Chinese policymakers picked up a copy of Art of the Deal.
OpenAI finally releasing its text-to-video AI tool, Sora.
It is just the beginning, and we will likely see more.
And things are now actually turning into real applications.
A significant number of small businesses are really exploring the use of generative AI.
It will result in, massive, I think, revenue growth and massive cash flow.
Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. Markets mostly unchanged today as Wall Street searches for its next catalyst. The Dow finishing down for the 7th straight day, while the S&P 500 saw its first weekly decline in 4 weeks. And the toy industry braces for a new round of Trump tariffs. We're going to tell you why the entire sector is so concerned. And then private equity invades the NFL. We're going to break down that. Plus, the $765 million contract that is dividing New York baseball fans. Well, U.S. stocks close mixed as the Dow and the S&P 500 cap weekly losses. Yahoo Finance's Jared Blickery joins us now with the trading day takeaways. Jared.
Thank you, Josh. This has been a week, in fact, 2 weeks of strange streaks, and I'm going to go through a few of them. First of all, the Dow is down 7 days in a row. Nevertheless, the Nasdaq just closed at a record high, and we've got a few other things, and I wanted to start with the very short end of the yield curve, and this is 13 weeks or 3 months. So we talk about the T-bill yield, and this has been down 10 days in a row, I believe, and let me just get that, 9 days in a row, and I'll just put a chart up here. You can see from the upper left to the lower right. And then let's take a look at the 10-year. This is going the opposite direction. So when we talk about the yield curve, you have the shorter end going down, you have the longer end going up. Guess what? The yield curve is widening, and a lot of times you see financials react positively to that. They have not done that. In fact, we've seen for the most part, most of U.S. equities kind of roll off. Not all of them, but some here, and it's just been kind of a week of strange streaks.
Strange stuff. Why is the SPX, the S&P 500, a broad gauge share? Why is that still so close to record highs here?
I'm gonna show this to you, and it has to do with something called the Mag 7 here. Here we go. Here's our mega cap screen. This is what's happened over the last 10 days. So this is basically December price action. You can see a little bit of red. Nvidia's down, but for the most part, these guys have been powering the entire rally. Not all of it, but most of it. Here's Broadcom, just up probably 20-25% today alone. That's one of the smaller ones. Alphabet up 12%. Microsoft and Apple 5% and 4% respectively. So that's where a lot of this strength is coming from.
Understood. Does it remind you of any other periods in history?
Why, I'm glad you asked that. So we've seen this before, and we in fact have a chart here. This is the number of outperformers. So this is the percentage of S&P 500 components. There's 500 total, but this is a percentage that are outperforming the index. So when we talk about breadth, and this is something that's been suffering recently, how many stocks are participating? So if you only have a few large cap stocks that are driving the entire market, that's something that a lot of people raise their eyebrows at, and they said that's going to come to an end. You look at this chart, when's the last time we had this low a participation? That would be the late 90s. Right after this, we saw the market roll over, and that was the end of the dot-com bubble. So there's some strange parallels here, and I'm not saying that we need to repeat that period, but it's worth paying attention to.
Explain to us, Jared, because you're right. We've had on the show a lot this week, this phrase bad breath. Why is that a worry for investors?
You really want to see more stocks participating because that's what a bull market is made of. However, it's also true that the lifeblood of a bull market is rotation. And I think that's what we're seeing here. If we can chalk this up to rotation, that we're just seeing different stocks fill in when other stocks flag, well, that's part of a normal market. But if this is a prelude to something else, that's when we need to worry.
All right. Another Jared Blickery point. Final
point. Is digital gold, is it greater? Is it better? Is it bigger than physical gold? Well, just according to the charts, we're seeing crypto really exploding recently. And I think since the election, it's really instructive here. And I'm going to show you a chart of, here we go. Here's gold versus Bitcoin. This is over the last month. And what you see here is gold in purple. This has risen a little bit, 2.8%. That's respectable. Here is Bitcoin. It's up 13%. And I'm going to show you something that's a little unfair. This is a year-to-date chart. This is Bitcoin all the way up here, up 133%. It makes the 27.79% in gold return. That's a great return for gold in a year. That's a great return for stocks in a year. It kind of dwarfs it by comparison. So gold has kind of suffered recently, and Bitcoin has been able to hold its weight. That's as the dollar has been rallying. That's as stocks have kind of rolled over. So that tells me crypto is really probably one of the strongest parts of the market, believe it or not, right now.
Over the weekend, what's on your radar? What are you watching? Is it Bitcoin, Dogecoin?
I think I'm going to get into sports. I'm just tired of watching Bitcoin and Dogecoin over the weekend. I'm going to get into sports this weekend.
You've worked hard. You deserved it. Thank you, Jared. And stick around. Much more Asking for a Trend right on the other side. Tariffs on Teenage Mutant Ninja Turtles? We could see a lot more, in fact, as even toy makers are bracing for second term from President-elect Donald Trump. For more, we're bringing in now James Zahn, senior editor at the Toy Insider and editor-in-chief at the Toy Book. James, it's good to see you. So Trump is returning to the White House, James. That means tariffs are front and center. He's a believer. And not just Trump. You know, those who surround Trump are believers. Besson, Lutnick. What could this potentially mean for the American toy industry, James?
Hey, good afternoon. And yeah, the Ninja Turtles don't want any tariffs. That's some evil shredder action right there. But this could mean some catastrophic results for the toy industry, especially the small to mid-sized companies. So some of what we've heard is a 50 to 60% tariff on products coming out of China. Now we're hearing maybe it could be a little bit lower, but anything is bad when you're talking about an industry that produces roughly 80-85% of its goods in China.
James, so most assembled in China, has that shifted at all, James, over the last 5 or 10 years? Are more toys assembled, for example, in Vietnam, Indonesia, other countries, other regions?
That's true. There has been a shift, and I would go back to Hasbro as leading the charge in moving some production out of China, and that was under the late Brian Goldner's leadership there, where they started looking for alternatives. When it comes to the publicly traded companies, Funko is probably in the best position because they make so much in Vietnam right now. But for the rest of the majors, you've got Jakks Pacific, Hasbro, Mattel, Spin Master making so much of their product over there. They have diverted some of it to these other countries. Vietnam is picking up a lot. Malaysia, India wants in on the action. The biggest problem right now is capacity. They don't have the capacity to take on the level and the volume of production that's needed. And they also don't necessarily have the expertise to get that fit and finish the way that the manufacturers need for these products.
Are there certain kinds of toys, James, that would be potentially more impacted than others?
There are, and a lot of this comes down to, and it's sort of deja vu from the last time President Trump was in office. There's products that you just can't make in the U.S. So when we talk about things like nearshoring or reshoring, there are certain things like highly articulated action figures, dolls with rooted hair, things with sort of a complexity to them. They're really hard to produce here domestically because we don't have the factories to do it. There's EPA regulations that sent that stuff overseas decades ago. So those become the harder hit products because that's what everybody's making over there. Even something like a steel truck, for example. I know a couple of manufacturers that have tried to make products here in the States, like there used to be Tonka, Buddy L, Nylint back in the day. Well, they can't do it here anymore because the factories aren't one size fits all. In order to make a truck that a single factory could pull off in China, you might have to find 5 or 6 suppliers here in the States to pull it off, and they just can't do it at an affordable cost.
Final question, James, because I got to ask you, we're heading into the holidays. Top toy, James, what makes the list? I did hear Barbie maybe pretty high up there.
Well, Barbie's always high up, and I'll tell you a little of the secret sauce on that. The Barbie Dream House, which could be a $200 item, is always at the top of the list every holiday season. So that's something you could sell fewer of for a high amount, and it shows up as being big dollars. But what's cool this year is Barbie Miniland, because consumers want more bang for their bucks. So we're talking miniature Barbie dream houses that are only $9.99, and then dolls that come in little lipstick containers that start at $3. So on our consumer side, Toy Insider, we did a 12 under 20 list that highlights a ton of products, and Ninja Turtles were on there, that consumers are going to find, and they're all going to be under $20. People want value, but they want good.
James, great to see you. Thank you for walking us through all that.
Likewise.
Appreciate it.
Happy holidays.
You as well. In a first for the National Football League, 2 private equity firms, Ares Management and Arctos Partners, have clinched separate deals to buy minority stakes in 2 franchises. Ares investing in the Miami Dolphins, while Arctos Partners taking a chunk of the Buffalo Bills. And joining us now is Joe Pompliano, Yahoo Finance Sports Report host. Joe, always good to see you. So the NFL officially entering the private equity era, Joe. Walk us through what this means for the league, Joe, for potentially team valuations, stadium renovations? What are some ripple effects here you see?
Yeah, thanks for having me, Josh. So this is something that's been happening in professional sports, specifically in the U.S. for the last number of years. But the NFL has really sat on the sidelines and let every other league test it out first. So the NBA currently has private equity investors, MLS, NHL, all the other leagues have it. The NFL now is moving into that realm also. And what they've done is they've placed limits on it, right? So you can only buy up to 10% of a team. You can only invest in a few teams, and they're all pre-approved. But what it allows people to do is it allows minority shareholders, or even majority shareholders, to take some cash off the table. It allows a group of investors who otherwise wouldn't have access to this investment to go and invest in a team. And it really democratizes that access, which is important because these valuations are now getting so high, where there's only so many individuals that are willing to write a check for $100, $200, $300 million with no control. So I think that's really helpful to the current ownership groups. And the private equity funds obviously love it because they're able to charge management fees and get some of the carry as well on an asset that's not correlated to the wider market and has appreciated over the last few decades.
So, Joe, would you guess more deals are likely to come?
Yeah, for sure. I think there's a number of deals that we're going to see coming over the next few years, but even further beyond that, as these team valuations keep going up, there's a world where some of these teams start trading at $15 to $20 billion over the next 7 to 10 years. Obviously, the top of the market with the Cowboys, Giants, Jets, all those teams, but even some of the bottom teams are going to be worth $10 billion. And if you're a minority owner or even a majority owner that's looking to get liquid a little bit, then you have no other choice. And these private equity funds are a great option. And my guess is we're going to see a handful more of those deals, probably within the next 12 months, and then outside of that, even more.
Switching gears, Joe, Juan Soto, mind-boggling, unprecedented contract with the Mets. Why, Joe, did he command that sum of money?
Yeah, it's really a tremendous amount of money. And I think even people inside baseball were shocked at this number. It was just a way higher number than anyone really expected that he would get. And look, he's a generational player. He's a fantastic player. You could, have a gripe with some of his fielding or his base running, but at the plate, he's phenomenal. He definitely deserves a large contract. And part of it is that he's so young. He's 26 years old. Superstars like that don't always come to a free agency at that age with 10, 15 years left on their life cycle in MLB. But I think really what this is it's Steve Cohen not caring, right? Steve Cohen is the richest owner in baseball. When he bought the Mets for a record $2.4 billion a couple of years ago, he said, I'm not doing this to make money. I just want to win a championship. He grew up a Mets fan, and that's exactly what we're seeing. This deal is more than Ohtani got at $700 million. It could go up to $800 million if the opt-outs kick in as well. There's really no world where Soto or any other player in Major League Baseball is worth that money to a team. But what we've seen with Cohen is he doesn't care. 2 years ago, they didn't even make the playoffs, and he spent $400 million on that roster, $100 million of which was luxury tax money, which gets paid to other owners because he went over the luxury tax.
Finally, Joe, I can't let you go without getting your take on Belichick going to UNC. I have two questions, Joe. First, why? I mean, this is one of the greatest coaches in the history of the NFL, obviously. Why is he making this move, Joe, in your opinion? And secondly, I got to ask you, were you surprised he wasn't offered a job by an NFL team last year?
Yeah, I think those two questions really go together. My guess is that he didn't think there was going to be a good opportunity in the NFL this upcoming offseason. And the media thing was always going to be a one-year thing, right? He was really doing that to stay in the spotlight, prove that he could adapt to the times, and then get a new job on NFL sidelines in 2025, 2026. But when you realize that that's not going to happen, all of a sudden you start looking at other options. And the way that the college game has gone over the last few years is it's essentially the minor leagues, right? You have free agency with the transfer portal. You have salaries with NIL. It's the same exact structure. So now he's going to go to UNC, which I think is actually a unique and good opportunity because they play in the ACC, which is a weaker conference. The winner of that conference gets an automatic bid to the college football playoff now. So there's a path. They have good resources at UNC. It's a beautiful state, beautiful area, et cetera. I think he has a really good path now where if he's able to put this thing together over the next 2 to 3 years, it could be legacy building rather than distract from the legacy that he's built in the NFL.
Joe, always great to see you and have you on the show. Thanks for joining us.
Thanks, Josh.
And be sure to scan the QR code below so you can stay up to date with the latest episodes of the Yahoo Finance Sports Report, dropping every Thursday at 5 p.m. Eastern. Stay tuned. More Asking for a Trend right on the other side. For our chart of the day, we're taking a look at market breadth. Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
This has really been the theme, hasn't it? Breadth, or more appropriately, lack thereof. In other words, even when we are seeing stocks rise on the day, it doesn't mean that the majority of stocks in a given index are rising. And that's certainly been true of the S&P 500. This chart coming to us via Bespoke Group. And basically what we have seen is this is the S&P 500 10-day advanced decline line. So the lower the line is, the more stocks that are falling relative to those that are rising. And what's happened now here is that this line has gone into what's usually called oversold territory. That means maybe things are poised for a bounce. This is as we have seen on every single day in December. Decliners have outpaced advancers. The implication of all of this is that the mega caps have done really well. And we talked to AVGO Silverman at RBC about what this could portend going into next year.
I think two things here. The first is when you think about next year, because the weighting of the market matters so much, we really can't have the AI trade or the mega cap tech trade or the Mag 7 fail. It has to be at least okay. And then second, if you want there to be kind of a healthier market, you really need to have that widening occur as well. But one cannot be bad, even if two is good, because, you know, as you'll see, it becomes that weighting that really interplays into the market.
Put another way, this line is fine as long as the mega caps are still going higher. So that is what we have seen a little bit, although on the week the S&P 500 is down. But just something to keep in mind here that yes, the market can go higher just because of the mega caps, but it is a healthier market, in Amy's words, if there is that more breadth of the advances that we see, Josh.
All right, thank you, Julie. And that is a wrap on today's Ask for a Trend. Be sure to come back Monday at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.